different ways that you can cut your tax bill in half or even down to zero 100% legally. So the first thing that you can do is to consider moving to a no income tax state. States that currently have no income taxes are Alaska, Nevada, Florida, South Dakota, Washington, Texas, and Wyoming. For example, if you earn $100,000 a year and live in a high income tax state like New York, you could be paying over 6% in state taxes alone. That's $6,000. Whereas if you move to a state with no income tax like Texas or Florida, you could save that $6,000 instead. To do this strategy, you could either physically move to the new state, or you can simply establish legal residency in the new state without actually moving there. There's a couple ways to do this, and this is actually what I did. I'm currently living in Mexico City, but my legal residence is in Texas, which has 0% income tax. And to do this, I have an actual Texas mailing address through a virtual mailbox service. This is really good for someone who works remotely like I do and spends time in different places around the world rather than at one fixed address all year long. So it really comes down to the difference between your residence and what you call your domicile. That is where I am registered to vote. Texas is where my business is registered, my vehicle is registered, where my driver's license is from, and it's where I receive all my important mail. However, even if you are a legal resident of a state with no income tax, if you make money in another state, you still might need to pay income tax in that state. So every state does have different requirements. It's not just a simple question of just getting a virtual address in another state and calling it a day, but there are a lot of ways to do this, and many people use this strategy because it's smart. So make sure to talk to a CPA or a tax professional to help you set this up properly. To understand my next tip, you first need to know that the IRS has different types of tax rates. There's income tax and then there's capital gains tax. Income tax is what you get taxed on out of your paycheck, and it ranges anywhere from 10 to 37% depending on your tax bracket. Capital gains tax is what you get taxed when you sell an investment at a higher price than what you bought it for. That profit is called a capital gain, and capital gains tax ranges from 0 to 20% for long-term gains and 10 to 37% for short-term gains. So my tip for you is, if you are planning to sell any investments, whether it's stocks or crypto, and those have appreciated in value and therefore you'd be selling at a profit, make sure not to sell that asset until at least 1 year has passed. That way you incur the long-term capital gains tax rate versus the short-term capital gains tax rate. Now, capital gains are taxed only when you actually sell at a profit. So you have a lot of flexibility in terms of when you incur the tax bill because you decide when to sell. And so what you can do with this is you can even sell an investment that has appreciated a lot. You can wait to sell that in a year that you have very low income and therefore you're in the lowest tax bracket. For example, maybe it's the year that you decide to go back to school and therefore you don't have a job, or the year that you get laid off. So there's a lot of leeway in when you can incur the capital gains tax and make it as low as possible. And now for a super tip. Do a Roth IRA conversion when the stock market is down. So a Roth conversion is when you move money from a traditional IRA or a 401k into a Roth IRA. I like Roth IRAs because once you put money in there and you invest it, it'll grow tax-free and you don't have to pay taxes when you withdraw either, no matter how much your investments have appreciated. That is why I always try to convert as much of my pre-tax retirement accounts into Roth style accounts as much as I can, because I'd rather just pay tax upfront and never worry about paying taxes when I withdraw. However, when you do a Roth conversion, you will owe taxes on the amount converted. So you don't want to just convert everything you have into Roth IRAs and then get hit with a huge tax bill. But here's the trick. You can lower the tax bill by doing the Roth conversion when the stock market is down. Therefore, the value of what you're converting is lower and therefore your tax bill will be lower as well. For example, let's say you have $100,000 in a traditional IRA or in a 401k. Now, if you want to convert that to a Roth, you'll have to pay taxes on $100,000, which is the amount that you convert. If your taxes are, say, 30%, you're going to owe $30,000 in taxes just for doing the conversion. Instead, let's say the market has gone down, and instead of your investments being worth $100,000, let's say they're worth $80,000. So if you do the Roth conversion, you'll owe tax on $80,000, or that'll be $24,000, assuming the same tax rate of 30%. So that's a huge difference. You save $6,000 in taxes by doing the Roth conversion when the market is down versus when the market is up. Now, side note, you'll want to do what's called an in-kind conversion, which is when you you transfer investments from the traditional IRA to the Roth IRA without actually selling them. You're just moving stocks from one account to another instead of selling the stocks and moving the cash to the other account. This is an in-kind contribution, and you want to do this so that you don't lose your place in the market during the conversion. Now, if you are watching this video, there's a good chance you've at least dabbled in crypto, so this next tip is great for saving money on crypto taxes. However, I will say that it also applies to stocks as well. Basically, if you bought crypto and it went up and now you're looking to sell, you will incur a capital gain and you'll owe tax on that, just like with any other asset that you sell. But the trick is that you can choose how that capital gain is calculated. So here's what I mean. Let's say you bought a Bitcoin in January, another one in February, and another one in March. Then you want to sell one of those Bitcoin in April at a profit. Well, which one did you sell? The one you bought in January, or the one you bought in February, or the one you bought in March? Let's say the Bitcoin you bought in January was at a price of $10,000, the one in February was at $20,000, the one in March at $30,000. So if Bitcoin is currently at $50,000, I'm using totally made up numbers here, then selling the one that you bought in January for $10,000 means a capital gain or a profit of $40,000. That would be the FIFO calculation method, or the first in, first out method of calculating capital gains. And the FIFO method assumes that the first one you bought is the first one you sell. First in, first out. Then there's the LIFO calculation method, or last in, first out, which assumes that the last one you bought is the first one you sell. So in this case, it would be the $30,000 Bitcoin that you bought in March, and you would be selling that for $50,000. So with the last in, first out LIFO calculation method, your calculated profit would only be $20,000. So just by choosing the LIFO calculation method instead of the FIFO calculation method, your capital gain in the eyes of the IRS goes from $40,000 to $20,000. And that'll make a huge difference in how much tax you're gonna owe. The next way you can save money on your taxes is to set up a business. When you're employed, your employer withholds taxes from your paycheck and you just get what you get after taxes. But when you have a business or you're self-employed, you have a lot more leeway to save on taxes because you have the ability to deduct business expenses. Business expenses can be anything from office supplies, dinner with potential clients, and even travel expenses if they are work-related. So let's say I fly to New York City for a work meeting, I can write off that hotel and the flight, and while I'm there, I might also meet up with friends and enjoy the city for a bit too. Or let's say you want a new laptop, that's a business expense. Or you have a home office, that's a business expense. Or you buy books, courses, coaching, you invest in yourself to become a better, entrepreneur and CEO for your business, you can deduct that from your taxes too. And this is really nice because these are all things that I would spend money on anyway, except that purely because I own a business, I can live my life and do things that I do anyway in a tax efficient way by deducting business expenses. Obviously, this doesn't mean that I'm gonna do things for my personal life and just call it a business expense. It all has to be justifiable, but all I'm saying is I can just organize my life in a way and do all the things that I want to do, but sort of just structure in a way where I can deduct as many business expenses as possible. Here's an example. Maybe I like to go out to eat a couple times a week. Well, instead of going out to eat with a friend, I might ask the friend to just come over my house instead, and instead go out to eat with a potential client so that higher, restaurant expense can be a business expense. This is really cool because when I first started working for myself, even though I was making less money than I was making with my Wall Street salary, because I actually paid way less in taxes, my net pay, like the cash flow that I actually got after taxes, ended up being about the same. So if you have any sort of side hustle or self-employed gig like dog sitting or consulting or graphic design or whatever, talk to your accountant about how you can be smart about deducting your expenses under the business so that you can lower your taxable income and pay less taxes. Another trick is something called tax loss harvesting, which is when you sell losing investments to get the tax deduction. For example, let's say you bought stocks for $10,000 and its value went down to $5,000. If you sell the stock, you can use that $5,000 loss to offset any other capital gains that you made elsewhere in your portfolio in the same year. And if you don't have capital gains to offset that year, you can also carry forward the loss to future years and use it then. Side note, the IRS has rules around tax loss harvesting. So you can't just sell a stock at a loss and then buy it back immediately and then claim that loss on your tax return, because that's what you call a wash sale. You didn't really sell the thing. So you can either just sell the stock at a loss, claim the loss on your tax return and call it a day, or if you don't want to lose your place in the market and you actually like that stock, but you still want to get the tax benefit, you can do the following. Sell the stock, claim the loss on your tax return, and then buy back a very similar stock in order to not lose your place in the market and still maintain your exposure to that area of the economy. For example, Let's say you sold $5,000 worth of American Airlines stock to harvest the losses for your tax return, and then you can buy $5,000 worth of Delta instead. That way you can still be invested in the airline market while benefiting from the tax loss harvesting. This is definitely a very cool tax trick, but as always, don't do this without professional guidance, especially when it comes to figuring out which stock to buy in replacement of the one that you sold at a loss. Another way to pay a lot less in taxes is by investing in real estate. And there are a couple ways you can do that, but we're gonna talk about two: depreciation and refinancing. As a property owner, you can deduct a portion of the property's value every year for a certain number of years, usually over a 20 or 27.5 year period. This is because the IRS recognizes something called depreciation, or the decreasing value of an asset due to time, wear, and tear. For example, if you purchase a property for $100,000 and then depreciate it over 20 years, you'd be able to deduct $5,000 per year in depreciation from your taxable income. What's cool is that depreciation is considered an expense by the IRS. It actually literally reduces your taxable income. However, it's not an expense that you actually paid out, like an expense that you paid to the plumber for repairs on your property or for cutting the grass. So ironically, depreciation has nothing to do with your property's actual cash flow, nor does it have anything to do with your property's actual market value. Just because the IRS lets you depreciate the property by $5,000 a year doesn't mean that the property is decreasing in value by $5,000 a year. If anything, it's going up year over year. So depreciation is a huge, awesome advantage to owning real estate. So after you take nice tax deductions every single year because of depreciation, while the property's market value is probably going up, let's say one day you want to cash out on the profits. This is where the second trick I want to talk about, refinancing, comes in. A cash out refi is when you refinance your mortgage to take out additional cash. So here's how it works with real numbers. Let's say you purchase a property for $100,000 and you took out an $80,000 mortgage to help you buy that property. Then let's say 10 years later, the property has gone up in value. It's now worth $200,000. So what you can do is, instead of selling the property, you can just refinance the old mortgage and take out a new mortgage, a bigger mortgage based on the property's now higher value of $200,000. So because banks will lend you around 80% of the property's value, you can now get a mortgage on this property of $160,000. So the bank will actually give you $160,000 for this new mortgage. And then you could use $80,000 of that to pay off your old mortgage, and then that leaves you with $80,000 extra of tax-free cash. Yes, you will have a bigger loan on your property, and therefore your monthly mortgage payment is also going to be bigger. But if the property value has increased, that's probably because the rents have also increased. So with that higher rent, you should most likely be able to cover that higher mortgage payment as well. So cash out refi is a much better way to access your equity than by selling, because first of all, it's tax-free, and second of all, you'll still be able to own the property. This is actually something a lot of real estate players do. They'll own a property, get a mortgage on it, wait for the property to go up, or renovate it and make the property value go up faster, and then they'll take out a bigger mortgage, pay off the old mortgage, and walk away with the tax-free cash out refi cash. And then they'll take that money and invest that in another property and rinse and repeat. All right, you've probably heard this one before, but I gotta mention it because it is the low-hanging fruit. And this is to max out your retirement accounts, such as your 401k, your IRA, or your HSA. If your employer offers a 401k, everything you put into it directly reduces your taxable income. For my high earners out there, this is the easiest way to instantly reduce your taxes by a lot. Now, in addition to a 401k, you can also consider opening a health savings account, or HSA. With an HSA, you can contribute pre-tax dollars, invest it and have it grow tax-free, and then you can use the funds for qualified medical expenses, also tax-free. It's pretty amazing. If you want to learn more about different types of investment accounts, such as the HSA, as well as where to open them and which ones are right for you, make sure to grab a copy of my Ultimate Guide to Investment Accounts right here. I'll put the link below. Now, if you're self-employed or you have your own business, you can also open a solo 401k, which allows you to put away as much as $66,000 a year. This is for 2023. So if you have your own business, this could be huge tax savings. I always max out my solo 401k as much as I can every single year. Another option is, if you own a business and it generates enough income, you can also open what's called a defined benefit plan, which is a more advanced strategy that allowed me to put away almost $200,000 tax-free last year. And then of course there's the Roth IRA, or if you make too much money, you can do a backdoor Roth IRA. So by maxing out all the retirement accounts you have available to you, and you have many different options. You can save for retirement, which we all have to do, and cut down a lot on your taxes. So are you ready? This is how you would cut your taxes in half. Let's say you're in a 35% tax bracket and you make a $100,000 salary. Well, then you'll pay $35,000 in tax, right? However, let's say after watching this video, you understand all the different ways to pay less taxes, and instead of making a $100,000 salary, you make $40,000 in business income, $40,000 through a cash out refi on a real estate property, and $20,000 in long-term capital gains from, the sale of a stock or of crypto. So it's still the same amount of income in total, $100,000, same as your salary, but you're paying a lot less in taxes. Because if you're in the 35% tax bracket, you'd pay $14,000 on your business income, $3,000 on your long-term capital gains, and of course, no taxes on your cash out refi, which means $17,000 in total tax. So that is literally half of what you would pay if you made all that money just through a paycheck. I am always shocked by how many tax tricks and loopholes involve business and investing. It just goes to show freedom can never be found in a paycheck, if only because of the taxes. So even if you depend on a paycheck right now, you have to be smart about using your paycheck to invest and start businesses. That is the only way you can legally reduce your taxes while also making more and more money, and of course gaining more and more freedom. I hope you enjoyed this video. Be sure to subscribe if you haven't already, and I'll see you again next week, same time, same place. Bye!